Well, good morning, everybody. This is Paul. I'm sitting here on the phone with Steve. And first of all, we've been speaking to each other since 6 this morning. Steve was actually up at 5 this morning, his time, meeting with our investment team. And so, Steve, I just wanted to get a recording out to my clients. I know there's a lot of concern with the markets, and with the president speaking last night, the markets are just getting really beat up today. So just talk a little bit about where the investment team is and how we're going to approach this virus and how long the concern is, and let's just talk a little bit about that. So first of all, how concerned are you guys currently with the virus?
Well, yeah, the virus itself, you have to understand markets are a leading indicator, a forecaster of what is anticipated to come. So our stance on this virus is we are at a level right now where the overall economy and investors in different industries, they're at a level of kind of maximum pessimism right now in terms of what they think this thing is going to do. And that's all being priced into the market right now. That's already happened. It's a leading indicator. And now we're about 25% or so off of the market heights, which that's a lot of the price decline that has been factored into the market as a result of the virus. And this virus, at the end of the day, it is just a virus. It's just a flu. And yes, it's a more severe form of it, but at the end of the day, it's going to be resolved. It's going to come to an end. And then all of a sudden we're left at a 25% discount in equity prices relative to 6-8 weeks ago. And combined with that, we're not only at a discount in prices, but we're in an environment where interest rates have come down even lower. The price of oil has come down even lower. And some of those things are extremely bullish from an equity perspective. When interest rates are low, consumers you can refinance at lower rates, businesses can lend at lower rates. There's no competition in terms of fixed income where bond yields are low. So to me, that's where dollars start flowing aggressively into equities. So as a team, overall, we're not concerned about the virus in that regard. It's caused a lot of it's been emotionally charged in the markets, and a lot of that's been priced in. Not to say that we won't see some continued volatility, but really I think the bigger question should be how are we getting ramped up to prepare for the opportunity that's going to be ahead. So that's really been our focus.
Well, and that was going to be my next question. So what are you doing to prepare and to ramp up to seize opportunity, or do you see any opportunity, and what's the plan with the investment team?
Well, and again, I think that's the big question. That's what we should be focusing on. And as a team here, we're focused on increasing the equity exposures across a lot of the different strategies that we manage. Now, we manage a range of portfolios based on different objectives, so we have to be cognizant around maintaining the intent of the portfolios. But along with that, we have a lot of leeway in terms of how much equity, how much fixed income exposure we have in different portfolios, and we are fully ramped up actually with allocation standing by to move into as we see some level of rough bottom in the equity market. So we're heavily prepared for that. Now, the timing of that's the tricky part. We still think that there may be a bit of volatility with the president's comments last night that has led to a little bit more uncertainty regarding the full impact of the virus, which again I feel like is being definitely overplayed, but at the same time that uncertainty, that emotion, we need to let that somewhat play out in the equity markets, which that's what we're seeing today. So we think we're pretty close, honestly, in doing that, and we're ready and standing by with that. And I think for investors, despite the fear and the uncertainty and seeing things fall, it's honestly I think it's a pretty exciting time because when all this is passed and with when we're left with the interest rate environment and energy prices and equity prices being brought down, we're left with a pretty a pretty neat environment for equities. And one final thing on that as well is a 20 to 30% bear market is completely normal, and I think it's difficult a lot of times to maybe remember that. 2008 was a little bit unique with a near 50% peak to trough decline. But the key there that I think is so important is there was a lot of fear, a lot of emotion then, but there was also significant structural and fundamental issues that were coming to light. And that to me is what led to such a significant decline then. But in today's market, structurally, we're in pretty good shape. So this, to me, is highly emotional. That's where I think the full extent of this is a little bit different than looking back at 2008. And I think that's critical for people to be aware of, because I hear a lot of comments around, we've been through this. We think maybe it's going to go down 50+%. I don't see it that way. I mean, for good reason. So I just wanted to make that comment as well.
Okay. And that being said, I mean, obviously, it's hard not to be emotional, especially when you're seeing, 7% decline in one day. I mean, I know the market hasn't closed today, but, the Dow's down 7.6% while we're speaking. What would you tell an investor at this point? What should they do? What's your overall thought? I know you think the markets are good, but what should an investor do right now?
Well, I think that there's a couple of paths. If you're working with a quality planner, that's done their job and has you in a pretty reasonable allocation based on your planning goals as a client, assuming that's in place, then I think there's a couple of paths. I mean, number one, I think you can essentially just stay put and let your advisor, let your manager kind of do what they need to do. And that's what we're doing. I mean, we are making strategic changes in the portfolios to try and capitalize on this. Nothing is being radically changed or fundamentally changed to bring people outside of their risk tolerance or anything. It's not like that, but we are taking action to add value. That's one path. The second path would be certain investors might have the ability to become a little bit more aggressive and still be within their overall risk tolerance. I mean, some investors may have capital that they're not depending on for regular distributions and other things, and maybe they have the capacity to increase risk slightly across their dollars. And so I can't say I would discourage that for those investors. Obviously, every situation's different, and we need to look at that. But I think for a lot of folks, and I've gotten questions on that from other investors that are really looking to put, I guess I would say, a little bit more of a significant amount into equity. So, I think there's kind of a couple of different paths again overall, but I think in these situations, one of the worst things we can do is just say, hey, we're scared to death, and let's just get out and abandon everything that's in place. Those are dangerous moves. I mean, I would never really recommend that. And so again, I think you really just have to keep the focus on the reality of where we are today, and in the context of markets being normal, and this being normal activity, and then trying to take advantage of that.
Okay. So let me just kind of paraphrase what we got going on here. So basically, there is going to be some impact to the economy. We know now that the NBA has canceled all their games, and probably the NCAA, if I had to guess, was canceling theirs. But bottom line is it's just a bad flu, and the economy's still good. Trump was just on the phone while we were talking. I was just listening to him on the news here, or watching him on the news here, and he was telling, flat out said what you said, hey, the market's going to be fine. And he's going to do whatever he has to make the markets good, because it is an election year. Don't you think that's one thing that we need to take in consideration?
Yeah, absolutely. I mean, and he's always been pro-growth. So I mean, he's going to do everything he possibly can in this to get things on track and get things pumped up, even from a fiscal perspective, with government spending. I mean, there are still tools in the toolkit to start driving this thing, and especially once we start seeing this flu dissipate, treatments come online. things can turn around pretty quickly. Maybe it may not happen. That's the time will tell. But I think that you got to look at the facts and look at the support around this, and there are a number of things that, in my mind, are going to promote some form of a pretty exciting opportunity for equities.
Okay. All right. Well, anything else you think we should let our clients know today?
No, I think that's a good recap. I would just encourage everyone. I mean, any questions on this stuff, we're happy to chat. We can have a lot of confidence in the plan that's in place, and that's the good news. We're prepared for this through the planning process. And so again, now it just comes down to how do we take advantage of it. So hopefully this was a little bit helpful to provide some clarity there, but we're looking forward. We're looking onto good things and treating this as an opportunity.
Well, I appreciate your time today. And so a couple of other opportunities I think are available right now. Number one is Roth conversions. Take advantage of it while some of our accounts are down. Definitely look at doing that. So if you want to do that, just give me a call. But also for you guys that are in the more conservative portfolios, we can monopolize on this. I think there's going to be a few more days, and I am talking with Steve daily right now just to see, hey, well, it's impossible to time the markets, Steve, but I know that I think we're pretty close to maybe getting a little bit more possibly aggressive with some of our clients that want to get more aggressive and take advantage of some of these situations that have been beat up. Some of these stocks have been beat up. We can make some changes in the portfolios and get a little bit more aggressive. So if you want to do that also, I know it's hard to do and it's hard to time the markets, but I would definitely be looking at some buying opportunities here very soon. Even though you're going to be doing it in the core portfolios, I think some of my clients that are really conservative might want to start looking at taking advantage of some opportunities.
Sure. Yeah, and I think those are great points. Roth conversion is a great point. The other thing, just to pick up on that as well, is for clients that have any real taxable gains, we can do some loss harvesting in portfolios, where I think these are all positive, productive things we can do in the midst of market volatility. I mean, we can sell things at losses in the portfolios to realize a capital loss, which then can be used to offset other capital gains, and we can replace that exposure with a similar investment to still remain in the market. So there's some strategies on the tax side that I think should be very much considered for folks that are in more of a taxable or a tax sensitive situation. So definitely let's take advantage of those planning strategies. I think you made one other comment too that I wanted to talk about. I mean, yes, there is these events closing down, travel being canceled and shut down, and there is a real economic impact to that. And so I think it's important to recognize, yes, there's an economic impact to it, but we have to also look at the global equity markets are down 25%. That is just trillions of dollars of wealth that has been kind of adjusted based on the expectations around what this virus is doing. And so I want to be cognizant there is a real economic impact, but does it balance with the amount of wealth that's already been diminished because of it? And that's, again, where I'm starting to see fundamentally, structurally, there's an opportunity because we're seeing an environment that it can be extremely beneficial for equities from a pricing perspective, interest rates, energy, all this stuff. And now we've got this emotional component that's adjusted prices and some level of economic impact. But I just don't see that completely lining up where, again, we're left with a pretty positive environment for equities.
All right. Well, I appreciate your time today. And, folks, once again, if you need to talk, feel free to call me at the office. I do have appointments, but we know that we're here for you during this time, and we are meeting with our investment team regularly to see what options and what we're going to be looking at doing. So feel free to give us a call. Steve, thanks for your time today.
Absolutely. Thanks so much.